Every self-respecting trader knows his NFPs from his NFTs. It's time to talk about non-farm payrolls. It's a high-impact economic report published on the first Friday of every month. This monthly release of data shows a handsome chunk of the US workforce employed in manufacturing, construction, and goods. As the name suggests, it does not include those who work on farms and also excludes private households, non-profit workers, and government employees. So you must be asking, what this has to do with my trading strategy? Well, stay tuned as I break down why you need to know the ins and outs of the NFP and how it affects the markets. Let's go. The jobs report can be split into various sections. We have the unemployment rate, average hourly earnings, and labour force participation rate, among many other stats. But the big deal is the NFP component. Why? Because it measures the actual number of paid employees, full and part-time, in the states and private businesses. Lots of analysts release their forecasts for NFP figures in advance of the actual release. So now you know the lowdown, let's look into why it's important. The report provides fresh insight into the overall health of the US economy and how the labour market is doing. If the labour market is growing, that means more people are making money, and the more spending will be, result in higher GDP. Employment figures can also have an impact on interest rates. Higher employment usually leads to higher interest rates because of central banks' monetary policies aimed at balancing inflation and growth. Interest rates are a significant factor for Forex traders as it influences the value of the currency. Higher interest rates tend to attract foreign investments, which boost the value of the local currency, vice versa. So simply, how does it affect the markets? NFP impacts US indices, the FTSE 100, the dollar, major currency pairs, as well as gold and oil. For example, a strong report when the NFP and other economic metrics exceed market expectations, this often suggests a high level of consumer spending in the United States. If consumption boosts economic growth, this could raise confidence of the US economic outlook. It does not end here. When growth is robust, interest rates tend to rise, which results in a stronger dollar. When the dollar is mighty, gold and equities suffer. On the flip side, a weak jobs report could fuel concerns over the US economy. This may result in the Fed lowering interest rates to boost consumption, which is bad news for the dollar, but good news for bonds, which are fixed income. Okay, let's talk about the blockbuster NFP data for July. The US economy added 528,000 jobs in July as the jobs market returned to pre-pandemic levels, which is much below the market forecast of 250k and above an upwardly revised 398k in June. The strong jobs report boosted the confidence of the US labour markets and raised expectations around the Fed aggressively raising interest rates to control soaring inflation. The dollar appreciated, US stock markets and gold dipped. So guys, the US jobs report is a big deal and it impacts mostly dollar-denominated currencies like the euro dollar, Australian US dollar, dollar yen, dollar Swiss franc, and pound US dollar. Remember, the NFP data release comes with enhanced volatility, so be sure to manage your trade before the report is released wherever you are in the world. Want information on other key economic reports? Please let me know in the comments section. Remember to like, share, and ring the bell. Until next time guys, thank you.